Let's connect with Giri. There is a big IIFL institutional equity conference on in the town, so he would be in a perfect position to tell us what the mood is, what the assessment is, what are the narratives and what are the conversations. Giri, good morning. Thank you for joining us. If I say that everybody is no longer fixated with consumers and consumer durables and autos, will I be saying right? And will I be saying right if I also say that everybody is obsessed with buying corporate banks and selling NBFCs?
Yeah, I mean, consumer and auto especially, one need not do anything more than look at the stock price, and that tells the story. As far as fixation with banks is concerned, I wouldn't go so far as to say that people have started concentrating their bets. We are in no means, by no means we are in a situation like last year where only a handful of stocks took the Nifty up. That sort of concentration is not seen yet. People are at this point just in a wait and watch mode, if you ask me. And we are only 2 months away from an election. So that's such a big event and so close to us that all other events diminish in importance. The liquidity position is probably why you're talking about NBFCs, but the bigger NBFCs are pulling through. We've seen that in the numbers in the recent results. So one might say that a move to quality within that space is possibly happening, but not in the broader market as of now.
So, in general, when you're talking to clients, when you're interacting with clients, what are you telling them that how should they approach this pre-election volatility period? Should they sit on cash or they should not worry about it?
See, that decision seems to have been made the way I judged it from my investor interactions last year itself. And because some crisis of confidence on the liquidity front happened, the whole wait and watch period got upfronted from just 2-3 months before the elections to almost a whole year. So from August, September last year, we've been witnessing a bit of a cooling off. But I think that depending on which way the elections go, if the results are good, and the market obviously would like the ruling party to come back strongly, and if we see that the NDA is not struggling to reach a majority but pulls through easily, then there could be a good amount of money that comes flooding in, and investors are in general at this point very likely to be happy to see continuity.
Hi there, good morning. Let's talk about the 10th IIFL Enterprising India Global Investors Conference then, and the theme being elections, economy and earnings. I'm going to touch upon one of those earnings, given that today, we've pretty much summed up all of the Nifty 50 earnings. Give us a sense as to how you've read into the quarterly numbers gone by, what have been, your key observations, and what is it that you're hoping to hear in the conference?
See, the conference certainly has had almost 20 to 25% higher participation in terms of number of clients. I don't know about the AUM, it should still be above 1 trillion like it was last year also. But the intensity of participation has certainly gone up, and that tells its own message. And the expectation is certainly a bit more of hope than we normally see. But we've been conditioned to it, because if you look at the last 5 years or 6 years, we have not had much earnings growth, although the Nifty has almost doubled. So that tells us that, one more year, that too a year where elections are around the corner, will be a period when earnings are not immediately given focus. But after the elections, 2-3 months out, I think that will come very strongly into focus. The quarter gone by does not give very strong indications one way or the other. Surprisingly, cap goods companies have reported good numbers. There have been several earnings upgrades, but there have also been downgrades, and spread out between sectors, a little bit more in auto and some select consumer names. So at this point, on an aggregate, very difficult to draw a picture which points to the entire market behaving in one direction on earnings.
Right.
Giri, morning. It was a double delight on the macro front just last evening with the factory output now crossing the 2% mark. And that clearly was aided by a rebound in the kind of manufacturing activity one has been seeing. Also to add to that, retail inflation for the month of January has also dipped further to now a 19-month low. Do you think hopes are now getting even higher of some more rate easing by the central bank in the month of April?
Yeah, central bank easing rates does seem to be something that's quite likely, and given the governor's speech and after that the data points. But let's not forget that even in the press conference that the governor did, most of the questions were, of the sort that is the governor not getting too far ahead in terms of being ahead of the curve? Is it enough to just read into the headline inflation? Is not food inflation the principal reason for the inflation, headline inflation being down? Now, crude will also slip at its current lowered level into the base some months out. And after that, this Y-on-Y benefit we've been having on energy will go away. And that plus any potential spike in food inflation puts us at risk of seeing a headline inflation climb rapidly. And it will look very awkward for the central bank to do two cuts and then pull back. But having seen how aggressively the current leadership in the central bank has been accommodative, one would not rule that possibility out. But the risks are definitely there. The state governments have been all over the place in terms of announcing loan waivers. The central government has its own social schemes, plus the RBI being accommodative. All that does throw a question about whether we'll be witnessing inflationary risks. Normally, one could argue that, if a good amount of capacity addition is also happening, then we could accommodate the growth. But if there is a growth spurt produced and government capex is going to tail off, and if private capex is not picked up, then we could end up seeing a little bit of inflation this calendar year itself. But on the other hand, once more I would like to remind you that if there is a good election result, if foreign money comes flooding in, there could be appreciation of the currency, there could be a dampening effect on inflation, and many of the current worries will get relegated to the background, and animal spirits could get rekindled. A second 5-year term for the BJP would enable fresh hopes to be parked.
I ask you a question which I'm sure you will have an immediate answer. Is it a good time to buy telecom stocks?
Good time from a very medium term perspective, like 3 years, 4 years, I would probably say yes, because Bharti looks almost certain to pull off its numerous efforts on deleveraging. The others like Vodafone Idea have only one plan, which is to do a rights issue, but Bharti has a bit coming from Africa, could be almost 7,000-8,000 crores, could also be stake sale in tower companies if that comes through, and it could also be a domestic equity issuance. So between the three, Bharti is well placed to at least get something out in the short order, and it has the backing of Singtel through very difficult times, and also a number of long-standing PE firms that have been in support. So I wouldn't have any doubts that 2-3 years out we'll see Bharti having a good market share. But if you ask me, is it the right time to buy? One would have to look at near term also. You don't want to buy and then see a 15% drop the very next month. And that remains a distinct possibility, because at this point the market is a little worried about companies whose leverage is stretched. And Bharti is at about 4.5 times debt to EBITDA. And even Reliance Jio is at about 3.5 times. So all leverage companies are seeing the market look at them with furrowed brows at this moment. So right time to buy, probably not from a short-term perspective, but if you're a medium-term investor, go for it.
Closing comments, and I have to ask you a question on Reliance, and you just brought out something which is sort of been in my head. If I look at the balance sheet of Reliance, the debt is at an all-time high. We may talk about Jio being successful, ARPUs are strong, market share has been decent. But why are markets not recognizing the fact that Reliance also is growing by borrowing capital?
Well, we tend to look at the ratio of borrowings to the operating cash flow, and because their core business has been so strong, and because telecom is also reaching the end of its intense capex period and beginning to show signs of becoming self-sufficient in cash generation, the markets are not very worried. But it isn't as if even the mighty Reliance Industries is completely immune, because they are out in the market looking for fundraising by making themselves more asset light by selling towers and fiber off. But at the same time, if they manage to do that, and they have a good chance of doing it, they'll have more headroom for growth, and their ability to concentrate capacity and deliver value which differentiates them only improves. So a lot depends on whether they are able to raise money. But if they raise money, then the markets will probably smile even more. So it's not the absolute debt that the market looks at and gets worried about. It's also these other things, the way the business is picking up, they're expanding market share in telecom, and the ratio of the debt to the operating cash flow, or EBITDA.
All right, Giri, we'll let you go on that note. Thanks much for joining in, and wishing you all the very best for the conference. 125 corporates, 600 investors going to be attending.